everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. We're going to talk this week about money in motion, a barbell for rate cuts. And now that the first highly anticipated Fed rate cut being in the books, I wanted to continue on our money in motion theme for fixed income investors. And, as we've seen since the September Fed meeting a couple of weeks ago, the money and bond markets have been consistently in motion. And as a result, I want to provide an updated hypothetical barbell for this new landscape. And with the Fed recalibrating monetary policy now towards rate cuts, the uncertainty going forward will now come from the timing and magnitude of this easing. So how can investors prepare their bond portfolio for this looming uncertainty, which, by the way, will more than likely carry into 2025 as well. And the barbell solution underscores the beauty of this strategy due to its flexibility to changing rate environments along the yield curve, exactly what we've been seeing. And the barbell I'm going to talk about here allows investors the flexibility to add duration while still taking advantage of the income available in the ultra-short portion of the inverted yield curve. Now, the adding duration aspect is designed to not only lock in yield outside of shorter dated maturities, but also offers the ability to take part in a bond market rally if the economy were to falter and rates were to decline even further from current readings. And as I've blogged and podcasted about recently, although one Treasury yield curve, the 2s10s, has now uninverted, the other closely watched measure, the 3-month 10-year, remains solidly in negative territory. And so against this backdrop, the ultra-short portion of the inverted yield curve still offers value from an income perspective. Now, beginning in April and throughout the summer months, I talked about the Wisdom Tree in-house barbell, which utilizes our Floating Rate Treasury Fund, USFR. That's for the ultra-short position, and our Yield Enhanced U.S. Aggregate Bond Fund, AGGY, for the duration counterweight. And this example implemented a 70-30 USFR AGGY allocation. And while the premise behind this positioning hasn't shifted a great deal, it's always a prudent idea to mark to market, and that's what we're doing. And the updated USFR AGGY barbell has shifted more to a 60% USFR, 40% AGGY blend versus the 70 USFR, 30 AGGY allocation that I just mentioned. So what's the rationale behind 60-40? Well, 3 points. Economic data still showing a moderate growth backdrop. Treasury yields, let's talk to Treasury 10-year, already pricing in a lot of good news, needs validation. And lastly, the U.S. 3-month 10-year curve, as I mentioned before, still inverted by, as I'm talking to you today, by about 85 basis points. So as you can see, this updated allocation provides a yield to worse of 4.68%, while bringing duration to just a little bit above 2.5 years at 2.62. So to sum it up, this hypothetical barbell potentially offers a yield advantage of more than 51 basis points versus the benchmark AGG, but with only a little more than 1/3 of the duration risk as I'm talking to you here today. So bottom line, the investment landscape for fixed income promises to be a fluid one in the months ahead, especially as Fed rate cuts play out. And the barbell allocation shifts presented here are not meant to be static in nature, but more of a dynamic process. And by toggling the weights on either end of the barbell, the strategy offers a user-friendly solution for investors to adapt their bond portfolios to any potential changes that may be needed. So I'm going to end it there. I hope everyone has a great rest of the week and be well. And before investing, carefully consider a fund's investment objective, risks, charges, and expenses contained in the prospectus available at wisdomtree.com/investments. Read it carefully.